Hey guys, what's going on? It's Philip here from Opes Trading Group. I'm doing another educational video for you guys today. I want to discuss order blocks, supply and demand areas, liquidity grabs, and many more things. So let's get started. So first things first, there's a lot of people that talk about order blocks, what they are. There's a lot of misconception about what they are. So first things first, let's just discuss what they are. So order blocks, in the simplest ways you could say, are forms of supply and demand zones. That's where they get their names from where banks are pretty much buying or selling a particular currency. So you have to understand how the market actually works, how the banks actually work in order to understand this concept. So first things first, the market is all about liquidity. The market's all about buy orders and sell orders, one against the other. So when a bank wants to buy or sell a particular currency, if they are buying or selling in large amounts, they are going to move the price greatly against them if they do it all at once. So what do the banks have to do? They have to pretty much break up their positions into small, manageable positions, which is then known as an order block. And why that is done is in order for banks not to move the price too much against them. So let's look at an example for now. Let us say that a bank wants to take a particular sell position with, let's say, $100 million. Now what we do know is that if the bank takes a sell position, let us say from this point over here, all at once, what that's going to do is going to drive the price to just go straight down. Now the banks do not want to do that in order to get the best prices possible for their whole $100 million position. So what do the banks do? The banks will then break up their position so they can be getting the whole $100 million sell, let's say as an example, in this particular block. So what that then does is it allows this particular bank to get the best prices possible within what's known now as a consolidation, and that is why consolidations have high volume before the price has to drive down. So what now happens is you can imagine this consolidation and where people's stop losses will be. So stop losses will pretty much be above and below this particular consolidation. And now this whole area is acting as liquidity. And you can imagine the more this consolidation goes on, the more liquidity that's building around this price, the more the order block is filling with orders by this particular bank. So what I want to do now is I want to show you an example on the charts of how this happens. Looking at Euro USD, for example, and we're looking at this area in particular. You can see this consolidation area, big wick to the upside before the price just dived straight down. Now let's pull up a chart of a smaller time frame and let's look at this area on, let's say, the 30-minute time frame. So what we do see is an area where the price is going up and down in a consolidation, and this is what's known as the liquidity grab, liquidity trap. Many people call it different things. So this is what people think is the manipulation that's happening in the markets where people are getting stop hunted. All this is just purely grabbing liquidity before the price goes down. So as you can imagine, as we said, all the sellers have their stop losses right above this zone over here. Once the price breaks up, takes out the sellers, they are then manipulated into thinking the price is now a buy, the price is now going up, only for the price to end up closing back in the consolidation zone and dropping straight down. So all this wick did is act as an area of liquidity. The stop losses acted as liquidity in order to get the best possible prices before the price drives down. So now if we also look at this particular order block over here, which can be seen on a smaller time frame right there, the price is moving sideways. You could say that there was a lot of orders and a lot of orders getting filled within this area. The same concept happens once again. This is where the retail traders are being manipulated. This is the liquidity grab where the price will break to the upside. Once again, stop losses get taken out for sellers, driving them to believe that the price is now moving to the upside, only for it to fall straight back down. And now what happens is this order block will start acting as an area of resistance once the price will come back to it. Because this particular presence of, let's say, a big player in the market has now created orders within this area and this zone. When we came back to this area multiple times, it acted as an area of resistance, driving the price straight back down from it. Now, once we did have a break, you could say that all the sell orders in this area were finally wiped or taken over, and now the price is able to move to the upside. And if you look here, you could see that our order block from previously is now the next area that the price is coming up to. So if you guys understand support and resistances, you now can add the order blocks that you can look for in your charts to understand why the price will reject or bounce off these particular areas. And now you can look for these liquidity grabs where the market has to grab liquidity from somewhere before driving the price in a particular direction. And now you can incorporate that into your trading in order to perhaps not be manipulated into thinking the price is going in one direction too early. If you have any questions, guys, please feel free to contact me so I can speak to you more about this topic, and I'll see you next time. Thank you.